From Deloitte Tax, welcome to the Tax News and Views podcast. In this series, we talk to specialists from Deloitte about the latest business issues. I'm Carrie Falkenhayn, your host for Tax News and Views. Today, we're having the second discussion in our new series focused on the sustainability credits that were included in the Inflation Reduction Act. Joining me today are Karl Obradovich and Jeremy Demuth, both from Deloitte's Global Credits and Incentives practice. And Karl, on the last podcast, you mentioned advanced manufacturing as one of the four main sustainability-related credit categories, or what you referred to as the core four. So which Inflation Reduction Act credits do you group in the advanced manufacturing core four bucket?
Yeah, thanks, Carrie. So there's two main credits there. The first one is Section 48C, Qualified Advanced Energy Project. This is a competitive application process that's administered through the Department of Energy. It reinstitutes the application-based credit for advanced energy projects at industrial or manufacturing facilities. The credit percentage is a 6% base credit and provides a 5 times multiplier for taxpayers that meet certain wage or apprenticeship requirements. That means a full bonus credit is 30% of a taxpayer's eligible investment. The IRA allows for $10 billion in new funding, $4 billion of which is reserved for projects located in energy communities. The second credit that falls underneath the advanced manufacturing bucket is Section 45X, Advanced Manufacturing Production. This credit is trying to encourage production and sale of certain energy components, including solar, wind, inverters, qualifying batteries, and critical minerals, which the list is about 50 items. So a lot that falls underneath the critical minerals umbrella. The 45X credit amount varies based on eligible components. So 2 exciting credits under the advanced manufacturing bucket.
I would agree. So let's get into them. So 48C, that is the Qualified Advanced Energy Project. That is the application process driven credit. So what should a company look for to determine if they have a qualifying advanced energy project?
Companies should start with their capital investment, specifically capital investment for projects that re-equips, expands, or establishes an industrial or manufacturing facility. This is for the production or recycling of certain energy property. Also, it's for capital investments that re-equips a facility with certain equipment designed to reduce greenhouse gases by at least 20%. The Department of Energy assesses applications based on factors such as commercial viability, domestic job creation, technical innovation, speed to project completion, and potential for reducing air pollution and greenhouse gas emissions. In prior allocations, the DOE has also considered additional factors, including diversity of geography, technology, project size, and regional economic development. Taxpayers can claim the credit after they receive allocation award and a certification letter from the IRS, and they have 2 years to place the project in service after receiving certification.
Jeremy, I know you assisted many companies in the prior version of Section 48C. From that experience, what can companies do to prepare applications completely and efficiently?
Yeah, absolutely. It was actually my first federal credits project back in 2009. So you could say it got me hooked in the area. The 48 Cap C applications are very extensive, and you're really working with the DOE process, and a process that they've really leveraged from their DOE loan guarantee programs. And so it's very important to be able to answer all of the questions they ask and have all of the attachments that are required. And that includes both qualitative and quantitative elements. You have to be able to tell your story around your project. But when they compare these projects in terms of deciding who gets awarded a credit allocation, they have to look at some hard numbers too. And those hard numbers include a calculation of the overall project's impact on greenhouse gas emissions. And they do a number of different formulas to be able to compare, as Karl said, someone who might be making a solar panel to someone who's making a wind turbine to someone who is reducing the overall emissions at their facility. So my main recommendation is to get involved early, find the right team of internal stakeholders, and make sure that you have access to all the information that you're going to need before you start the application filing process. Otherwise, you're going to come up against deadlines because typically there's not a huge window to file these applications.
Sounds like some good advice. So let's switch to the other credit that we teed up here, Section 45X, which is the Advanced Manufacturing Production Credit. Carl mentioned that the credit is for the production and sale of certain energy components. So how does the Inflation Reduction Act define production? Jeremy, maybe you can comment on that.
Sure. Really, it doesn't define production within the code section. So what we're sort of left with right now, anyway, before there's additional guidance, is to look to other code sections. And luckily, there are other code sections that use this concept of production in the United States. And that's really what they're trying to incentivize here, is for folks to start, companies to start building or producing some of these components or refining some of these critical minerals in the US. If you look at code sections like 263 Cap A in terms of when you have to capitalize certain costs, there's certainly a very broad definition of production in there. Section 199 has the concept of manufacturing and production in the United States, Section 954, and several others. Certainly, there is a number of areas within the Internal Revenue Code where they define production that can be a useful stand-in before we get guidance in this space.
And are there any other special provisions or considerations related to this credit?
Yeah, absolutely. The credit is, on its face, simple, where it's incentivizing the production and sale of certain components in the United States. And for most items within 45X, they have a certain number of volume and a certain dollar amount per volume. You multiply it out, you have your credit amount. However, there's a lot of complexity there because in addition to needing to determine whether you're a producer, whether you're producing an eligible component, you also have to make sure that you have a third-party sale. You have to be able to understand what happens when you integrate your component into something else and whether that subsequent component is also an eligible component. And so you have a lot of different areas where there's some complexity. And in addition, you have other areas of 45X where the amount of benefit is not based on a volume multiplied by a dollar amount. It's actually based on 10% of cost. And cost is also not defined. There are certainly other areas of the tax code where you define cost and really focusing on the cost associated with that production in the US. So certainly there are a number of areas within 45X where you have complexity, and taxpayers really need to be careful considering the significant benefits that are available.
So you described two complex but lucrative credits, 48C, Qualified Advanced Energy Product, and 45X, Advanced Manufacturing Production. Can an organization take advantage of both?
Unfortunately, no. You really have to do a modeling exercise because 45X and 48 Cap C cannot be taken on the same facility. So it's really a comparison between the volume that you expect to produce and be 45X credit eligible to the cost of the essentially machinery and equipment you're going to install under 48 Cap C. Certainly there are other considerations. The fact that Carl mentioned 48 Cap C is application-based, 45X is claimed on the return, 45X is eligible for direct pay, 48 Cap C is not, but is eligible for transfer. So it's really a comparison of the pros and cons of each, and taxpayers are going through that process now.
So Jeremy just mentioned transferability and direct pay. And Carl, on our last podcast, you discussed how credits can be utilized. Maybe you could talk a little bit more about how those concepts work with these two credits.
Yeah, so transferability under Section 6418 is available for both Section 48C and 45X, excluding tax exempts and certain governmental entities. Direct pay under Section 6417 is available for applicable entities, which essentially is tax exempt and certain governmental entities. So when you look at Section 48C, that's only available for the applicable entities. However, Section 45X is also available for applicable entities, but it's also available for other companies for 5 consecutive years. In addition, the carry back and carry forward has been extended. So the carry back has been extended from 1 to 3 years, and the carry forward has been extended from 20 to 22 years for tax years beginning after 2022.
Well, an interesting discussion, and certainly a lot for organizations that are investing in sustainable manufacturing to think about. So thank you, Carl, and thank you, Jeremy. I'm really looking forward to our next conversation where we go through another one of the big 4 Inflation Reduction Act credits. But in the meantime, I'd like to thank the audience for joining us, and I hope you tune in for the next webcast. And I also hope you all continue to be well. Take care, everyone.